70 cents a gallon. Gone. That's what people across the Midwest are seeing at the pump compared to just months ago, and it's not because of a hurricane, a refinery fire, or some mysterious market forces excuse. It's because a trade war that was marketed as strength has mutated into a domestic cost of living weapon. And the number you need to remember is this. The bill is already being counted in the tens of billions, while the real damage is showing up in the only place that matters, your daily life. Picture the scene. You're at a gas station in Wisconsin. You're watching numbers climb in real time, not on a chart, on the pump. Meanwhile, your grocery bill is up, your insurance is up, your car payment is up, and the new normal is that everything costs more because the supply chain is now carrying a political toll. Now here's the part that almost nobody in Washington expected, and it's the pivot that changes the entire story. Canada didn't back down. Canada turned to China. And if you think that's just a trade headline, you're missing the geopolitical chess move. Because what we're watching is America's closest ally, an integrated energy partner, an intelligence partner, a border we've treated as strategically secure for generations, beginning to behave like a country that no longer trusts the United States as a predictable counterpart. That is not a Canadian betrayal. That is a signal that American coercion is producing the opposite of compliance. It's producing realignment. Stay with me, because in a few minutes, I'm going to show you the single biggest myth driving this disaster, the myth that America is energy independent. And after that, we're going to talk about July 2026, a deadline most people aren't watching that could trigger the slow-motion collapse of the entire North American trading system. If you understand what's at stake before that deadline, you can understand why prices are rising now and why the next phase could be much worse than higher prices. It could be shortages. Welcome back to the Dollar Watch. If you want the real mechanics of how policy hits your wallet without partisan bedtime stories, subscribe and stay close. This story is developing in real time and the follow-ups matter. Let's start with the hard dependency the United States pretends it doesn't have. Roughly 60% of imported crude oil into the US comes from Canada. But that statistic alone doesn't tell you the trap. The trap is chemistry. A huge portion of what flows down from Canada is heavy crude. Thick, dense, high sulfur. The kind of crude you don't just swap like you're switching brands of soda. Many Midwestern refineries were built and optimized over decades for that grade. The equipment, the cokers, the desulfurization units, the entire configuration is tuned for a specific feedstock. So when tariffs hit Canadian energy, whether it's a direct tariff on crude or indirect retaliation costs, or administrative friction that behaves like a tariff, those costs don't float harmlessly in the market. They route into the Midwest gasoline crack spread. They land in the Rocky Mountain states. They show up as 30, 50, 70 cents a gallon, over and over. Every fill-up, every delivery truck, every commute. This is why trade wars are so dangerous. They don't just raise prices, they distort infrastructure that took half a century to build. And yes, you've heard the talking point. America produces more oil than anyone. We export oil. We're independent. On paper, the US is a top producer. Much of that production is light, sweet crude, especially out of shale basins. That is not the same input as Canadian heavy crude. Refining is not ideology. It's physics. If your plant is designed for heavy sour crude, feeding it light sweet crude is not a clean replacement. You can blend, you can reconfigure, you can invest, but you can't just flip a switch without massive cost, downtime, and capital expenditure. Now ask yourself a simple question. If this is so easy, why haven't we already solved it? Because the system was built for efficiency under stable rules. Cheap Canadian heavy crude flows south through pipelines. Midwest refineries process it. Consumers get stable supply. That's the integrated machine. Trade war logic assumes you can shock that machine, and it will obediently reassemble itself in your preferred direction. That's not how industrial systems behave. They break, they reroute, they punish you. Here's another open loop I want you to hold. The oil story is only half of it. The auto story is where the damage multiplies like a virus, because the North American economy isn't three separate economies. For decades, it's been one integrated production zone. And when you weaponize the border, you don't protect jobs. You introduce friction into a machine built on speed. A single automotive part can cross the US-Canada border multiple times before it lands in a finished vehicle. In some cases, you're looking at a component that moves back and forth for casting, machining, assembly, finishing, inspection, and final integration. Every crossing adds paperwork. Every crossing adds delay. Every crossing adds cost. And when tariffs or tariff-like costs apply, you don't pay them once. You pay them repeatedly, compounded through the chain. That's why the idea of targeted tariffs is often a fantasy. In an integrated supply chain, a tariff is rarely targeted. It's systemic. So when you hear that the goal is to bring manufacturing home, you need to understand what that would actually require. New plants, new tooling, new supplier networks, new workforce training pipelines, new environmental permits, new logistics. This is not a 6-month pivot, it's a multi-year re-architecture. And while that re-architecture is being negotiated in political theaters, you are paying the transition tax in real time. Now let's talk about the deadline that should be keeping executives and governors awake at night. July 2026. On July 1st, 2026, the US, Canada, and Mexico face a joint review of the trade framework that replaced NAFTA. Most people heard about NAFTA their entire lives without understanding what it really was, a continent-scale decision to treat North America as a single production platform with tightly interlocked supply chains, integrated energy flows, and a business reality built around predictable cross-border movement. NAFTA had flaws. It created winners and losers. It hollowed out certain communities and enriched others. That's real. But it also created an industrial ecosystem optimized for one thing: frictionless trade. When NAFTA was renegotiated into a successor agreement, the continent didn't deintegrate. It simply adjusted rules and continued operating as a single machine. That machine is now being threatened by a review process that can either extend stability or open the door to termination over time. And here's the part most people don't understand about trade agreements. You don't have to formally cancel them to destroy them. You just have to inject uncertainty. Capital hates uncertainty. Supply chains are built on time horizons. If executives believe the rules could collapse, they stop investing. They start hedging. They start locating future production elsewhere. That is how you lose an industrial base. Not with one dramatic announcement, with slow capital flight. Now enter Canada's new Prime Minister, Mark Carney. This is not a normal politician. This is a technocrat with a crisis resume. Former head of the Bank of Canada, former head of the Bank of England, former chair of the Financial Stability Board during the post-2008 era when global finance was duct-taped together with swap lines and emergency liquidity. Carney understands something most politicians never fully grasp. Power is not the loudest speech. Power is balance sheets, settlement systems, and leverage points in supply chains. So while the previous Canadian political style was more performative, press conferences, statements, outrage diplomacy, Carney's style is quieter and colder. He doesn't just complain. He repositions, and that's where the story gets dark. Because Canada holds meaningful amounts of U.S. treasuries. Canada is embedded in U.S. energy security. Canada supplies strategic minerals. Canada shares Five Eyes intelligence. Canada has been treated in American strategic thinking as part of a secure continental fortress. If Canada begins to treat the United States as an unreliable partner, it doesn't just change trade flows. It changes the security architecture of the Western Hemisphere. Now let's go to the event that fundamentally altered Canada's negotiating leverage: the Trans Mountain expansion. For years, Canada's oil had a captive buyer problem. Most Canadian crude flowed south because infrastructure flowed south. The US had leverage because geography had leverage. If you can't reach other markets, you swallow your neighbor's terms. But when Canada finished expanding pipeline capacity to the Pacific, it gained access to Asia. That sounds like a basic infrastructure story. It's not. It's a sovereignty story. Because once Canadian barrels can reach Asian buyers, Canada is no longer forced to accept American political pressure as the price of market access. And China, whose refineries can process heavy crude, has been eager to buy. This is where the United States made a strategic miscalculation. It assumed Canada needed the US more than the US needed Canada, and therefore Canada would absorb the pain and comply. Instead, Canada diversified demand. So the tariff doesn't punish Canada. It punishes American consumers. You pay more for gas. Trucking costs rise. Diesel rises. The cost of moving every product across America rises. That cost shows up everywhere because transportation is embedded into everything you buy. And when analysts estimate that crude import tariffs cost households real money per year, they're not even fully capturing second-order effects. The first-order cost is the direct price impact. The second-order cost is the inflation ripple through logistics, food distribution, manufacturing inputs, and retail pricing behavior. Now let's escalate the scenario to the one that should genuinely scare you. Restrictions, not tariffs. A tariff is painful, but predictable. A restriction is destabilizing. If Canada ever signals it might restrict energy exports, even temporarily, the issue isn't gas prices are higher. The issue becomes physical supply is interrupted. In that environment, you don't get a smooth price curve. You get scarcity behavior. You get panic buying. You get rationing. You get trucking disruptions. You get shelves that don't replenish on time because the delivery network is fuel dependent. And remember the infrastructure reality. The pipelines flow south. The refineries are configured for heavy crude. Rebuilding or reconfiguring is possible, but it takes years and billions. And during the transition, you would be running an economic stress test on the entire interior of the United States. So when people say this is leverage, understand what it really is. It's dependency. And by turning trade into a weapon, we revealed that dependency to the world. Now let's talk about manufacturing, because this is where the trade war story goes from you pay more to you lose capacity. Take America's iconic vehicle segment. The pickup truck supply chain is global. The parts footprint spans dozens of countries. But the critical point is that North America itself functions like a single factory floor. Canada and the US don't just trade finished goods, they co-produce them. When tariffs hit automotive goods and components, companies don't simply eat the cost out of patriotism. They pass it through where they can. They pause production where they can't. They cut shifts. They wait for clarity. They begin to question whether future capacity should even be located inside a region that is turning trade rules into political grenades. This is how you end up with temporary shutdowns, delayed EV production, price hikes, and a steady creep upward in the average new vehicle price. And vehicles aren't a luxury category anymore. In much of America, a car is survival. It's access to work, access to healthcare, access to basic life. So when the average price rises and financing costs rise, you don't just hurt consumers. You compress mobility. You reduce labor flexibility. You damage the real economy. And the auto sector is just one example. Tariffs on steel and aluminum don't stay in steel and aluminum. They embed themselves into every beam, every appliance, every building material, every industrial tool. You're not taxing a metal. You're taxing the capital stock of the country. That's why a trade war can function like a stealth austerity program. It raises the cost of maintaining and expanding productive capacity. It hits investment. It slows growth. And then politicians act shocked when GDP disappoints. Now, I want to bring you to the moment that should have set off alarms across the American national security establishment. In January 2026, Mark Carney traveled to Beijing and announced a deeper strategic trade posture with China. Not symbolic, transactional, specific quotas, and tariff reductions. Canada agreed to allow significant volumes of Chinese electric vehicles into its market at low tariffs. China reduced tariffs on Canadian agricultural exports like canola dramatically. Canada set targets to increase exports to China by 2030. Now, you might be tempted to treat that as Canada playing both sides or Canada being opportunistic. But the deeper point is what Carney said, because it's the kind of statement that rewires strategic assumptions. He described China as more predictable than the United States. That's not a compliment to Beijing, it's an indictment of Washington. And when a Five Eyes partner signals that the US is less predictable than China, you're not watching a trade dispute anymore. You're watching credibility collapse. This is how empires lose influence in the modern era, not always through military defeat, through trust degradation, through transactional unreliability, through turning alliances into extortion. Now, let's talk about the security spillover, because this is where the economic story becomes a geopolitical problem. Canada has massive reserves of critical minerals: lithium, nickel, cobalt, uranium, rare earths. These materials are not optional in a 21st century industrial and defense economy. They are inputs into batteries, semiconductors, avionics, guidance systems, communications infrastructure, and high-performance magnets. For years, American strategy has been to friendshore critical supply chains, build them with allies, reduce dependence on adversaries. Canada was central to that logic. But if Canada begins welcoming Chinese capital deeper into its resource sector, and if Canadian export pathways increasingly point toward Asia and Europe instead of the United States, the American industrial base becomes strategically more exposed, not less. In other words, we tried to punish Canada economically, and in response, we incentivized Canada to monetize its strategic assets with our rival. That is not strength. That is self-inflicted vulnerability. And the real nightmare scenario isn't that Canada chooses China. The nightmare is that Canada chooses diversification because Washington taught them that dependence on the US is a single point of failure. Now bring this back to your life, because this is not just grand strategy. This is grocery bills, jobs, and communities. The trade war hits hardest in places that were promised protection. Farmers are a perfect case study because agriculture is one of America's most export-sensitive sectors. When key markets impose retaliatory tariffs, farmers get hit on volume and price. Exports fall, domestic supply backs up, prices drop. Meanwhile, input costs rise because equipment, fertilizer, and fuel are more expensive in a tariff-inflated economy. That's a squeeze. Lower revenue, higher costs. And for farmers, that's existential. That's not a political debate. That's foreclosure risk. Border communities are another case study. When cross-border traffic drops, you don't just lose tourism. You lose retail flows. You lose hotel occupancy. You lose restaurant revenue. You lose the small business ecosystem that depends on predictable movement of people and money. And here's the cruel part. Those border towns aren't the caricatures you see on cable news. Many are small, working communities that don't have a tech sector to fall back on. When traffic drops 20% to 27%, you feel it immediately. It's empty parking lots, it's reduced staffing, it's closed signs. Now we reach the climax point in this story, July 2026. That review is not a ceremonial meeting, it is a credibility checkpoint. Either the parties extend stability, or the agreement enters a rolling uncertainty regime that can end in termination. And if the agreement weakens or collapses, you don't just get some tariffs. You get the unraveling of an integrated continental supply chain system that took decades to build. Think about what that means in practical terms. It means higher input costs for US manufacturers, longer lead times, more inventory hoarding, more working capital trapped in warehouses instead of invested in productivity. It means companies look at North America and see political risk, and they begin to de-risk by investing elsewhere. Meanwhile, Canada continues building parallel pathways. Canada already has stronger access to Asian markets through trans-Pacific arrangements. Canada has access to European markets through its EU trade framework. Canada has begun signing defense and security cooperation deals that do not automatically include Washington. Read that again, Because it's historic. A formal security and defense partnership between Ottawa and Brussels is not just paperwork. It is Canada building strategic redundancy. It's Canada saying, we need options. It's Canada hedging against American unpredictability. In financial language, Canada is diversifying counterparty exposure, and that is the most damning verdict on the trade war strategy. The goal was to force compliance. The result was to force diversification. This is what happens when policymakers misunderstand leverage. They assume the other party has no alternatives. They assume dependency equals submission. But dependency, when weaponized, incentivizes escape. The moment you show an ally you're willing to use their dependence against them, you teach them the rational survival move. Find other buyers, other lenders, other defense partners, other supply chains. That's what we're watching now. The North American economy didn't crack from enemy action. It cracked from friendly fire. Now let's bring it home with the blunt question you should be asking as we head toward July. What if the US can't repair the damage? Because every day that passes, Canada strengthens alternative relationships. Every week, capital flows into new pathways. Every month, supply chains reroute a little more. And supply chains, once moved, don't easily come back. Businesses hate rework. They hate retooling. They don't do it unless they have to. But once they do it, they build permanence. That's why this matters now, not later. By the time the average person feels a trade agreement collapse, the capital has already repositioned. The deals have already been signed. The dependency has already shifted. So here's the hard reality. The trade war was sold as a way to make America stronger. Instead, it is making America more expensive, more isolated, and more strategically exposed. It is raising the cost of living through energy and manufacturing channels. It is squeezing farmers through retaliation and oversupply. It is bleeding border communities through collapsing cross-traffic. And it is pushing Canada, the partner we assumed was locked in, into a posture of strategic diversification that benefits China. That is not winning. That is a slow-motion self-own. If you're seeing higher fuel costs, higher vehicle prices, weaker local business conditions, or export pain in your region, drop it in the comments. I read them, because the best macro intelligence is often local reality showing up before it hits national headlines. And if you want the follow-up, subscribe, because the next phase is not about theory. The next phase is July 2026, and what happens in that room will determine whether this stays a painful cost of living squeeze or becomes a structural fracture in the continental system that has underwritten American prosperity for a generation.